Move swiftly on. Your host for the next session is former FT journalist, broadcaster and commentator on CNBC, Nadine de Riza. So Nadine, if you come to take the stage and then you can introduce your panel. Thank you very much.
Thank you.
Your questions are set up on the iPod.
Thank you very much. Well, good morning, ladies and gentlemen. Good morning. Lovely, you're alive and awake. Well, it's fantastic to hear Sir Ivan. Obviously, we will be picking up on some of those themes. Just so you know, I've got three panellists who are going to come up in just a moment. If you do want to submit a question, then please use the app to do so, and I will endeavour to get through as many questions as possible. Depending on time, I'll also take questions live from the floor as well, and we've got 4 microphones to do that as well. So start thinking up your questions now. So without any further ado, please welcome on stage Jim, Marilyn and Michael. For you, take a seat. Marilyn, good to have you here. Thank you very much. Hello, Michael. Have a seat, please. So the idea of this is we've got 30 minutes to cut through the noise and share with you what the panellists think are going to be the key global trends that are going to affect you. What are the opportunities? What are the risks? What are those black swans? So 30 minutes is going to go by incredibly quickly. But Jim, first of all, if I can turn to you. Now, Jim Reid is MD, Global Head of the Fundamental Credit Strategy Group and Research Strategist at Deutsche Bank. And I noticed recently that asset managers voted Jim Reid as best in class, #1 in 4 categories. Your head's going to get bigger and bigger now in economics, fixed income strategy, investment.
We've only got half an hour.
Indeed, yeah. Investment grade strategy and high yield strategy as well. And I know your early morning bulletins that you issue on behalf of Deutsche Bank are widely read, one of the most popular bulletins to read. So what has your bulletin said this morning that would interest the audience?
It was a long time ago now since I wrote it. Well, I think the main story at the moment is probably, I think the key is going to be US inflation. That's going to be the glue that probably holds markets together or breaks markets over the next 12, 18 months. I've not really, in this post-crisis world, not really thought inflation is too big of a problem. But in the last 12, 18 months, I think there's signs that the US is now at full employment, output gap is closed, and you've just had a big tax cut in the US. If this doesn't generate some inflation, I've got to go back and relearn all of my economic studies over the last 20, 30 years. So I think the biggest risk observable out there is a notable increase in US inflation.
And when you think about it at the moment, I think you've described it as the Goldilocks economy of the US, but that inflationary pressure could change everything. What impact could it have?
Well, obviously, we've got a huge amount of debt in the global economy, and that debt is serviceable in a low-yield environment, low-rates environment. So if you start to get US rates moving up and US inflation, then clearly the serviceability of that debt starts to become into question. Now, let me stress, there's a lot of people that don't think US inflation is going to go particularly much higher than where it is today. So it's a huge debate out there.
So at the moment, roughly around about 2%.
Yeah, and most people think it tops out in the low 2%.
Got it. Marilyn, welcome to you. Marilyn Watson, who's MD, Head of Global Fundamental Fixed Income Strategy with BlackRock, and obviously formerly with the Bank of England, I think about 6 or 7 years ago, where you worked as an economist and deputy agent in the Monetary Policy Division. What's concerning you at the moment, Marilyn? And welcome.
Thank you very much. Thank you. So several things are concerning me at the moment. So while we think that the global economy is actually continuing to grow at a very sustainable, robust pace, we've seen that being driven by the Eurozone, driven by the US, to a certain extent driven by China as well. We are starting to see a little bit of a tick down in terms of the data coming out of the Eurozone, admittedly from very high levels, but nevertheless, we are starting to get a little bit concerned that it's not really going to perhaps be the driver that we expected it to be this year and next year. As Jim said as well, we also do think in the US inflation could be a potential risk. We also think it will continue to tick up, particularly when you see this fiscal stimulus. And if you were to see, which is not our core scenario, but if you were to see perhaps more of a protectionist stance with actual implementation of measures, you could also start to see a little bit more inflation coming through in the US, but also a dampening of really investor sentiment as well globally. So I'd say that they're the risks to what we think is a relatively positive picture, but there are a number of different risks, both political and economic, that could reduce that.
And just go back to the Eurozone, how much could Italy spoil the party? Because we've seen some great growth. How much will that divert the attention of the ECB and other leaders?
Yeah, so Italy is a concern. I mean, we've seen, throughout Europe, a range of concerns. We saw, how the market reacted when we had the French election, which turned out to be very benign. We've seen issues in Spain, in Italy. So I think the market, to a certain extent, has become a little bit numb to different political events, and Italy is certainly used to it. The market is obviously pricing Italy, wider than Portugal at the moment. It is pricing in some risk. But I think if you look at the potential new coalition, where you do have the five-star movement, when you have with Liga, they're very populist parties. It looks like they are actually going to increase their fiscal deficit. And it just really increases the unknowns and the uncertainty out there, which I would say does pose risks to the Eurozone in the longer term.
Yeah, thank you, Marilyn. I'm waiting very patiently on the end. I'm going to attempt to do your lovely surname, but I'm sure you will correct me. So, Michael Savitsky.
Close enough.
Close enough. There you go. That's very polite of you. How would you like to say it yourself?
Savitsky is great.
Great. Okay. And you're a senior economist with the Lloyds Banking Group, and I know you've worked within the Chief Economist Office of Lloyds Banking Group, which basically provides economic planning assumptions and advice to the group's board and executive committees, really looking at stress testing purposes. So, after hearing Sir Ivan, has that changed anything that you might go back to the board?
Well, I mean, I think the sort of central view that we take for the planning assumptions really is I think, takes account, I guess, some of those uncertainties. I think the easiest thing to assume as a base case is that there is this transition agreement in it. We, of course, all realize that it is just this political agreement on paper at the moment. But what we transit to later on is something which effectively has a low level of integration with the EU than what we have at the moment. So if it's just a free trade arrangement, or maybe with a bit of a boost, a customs union. I think the thing for most economists, 19 out of 20 economists probably would agree, is that there is some long-term cost to this, and that's kind of fairly, I think, standard as an assumption. But the thing which I thought was very interesting from Sir Ivan's sort of presentation is that there is also a lot of focus in the UK government, I guess, on this Brexit deal, inevitably, and it is basically diverting attention from everything else. So if you think about these sort of big political economic issues that the UK is facing around inequality or the housing market or how we're going to fund our public services with an aging population, all these things are not at the moment really being looked at in any serious way. So clearly there is an alternative government arrangement which is sort of prioritizing these things, and that might be a big risk to think about domestically if there is that change to a Labour-led government. Yes,
life does seem to be put on hold. And how about the business of forecasting? Is that getting easier or more difficult?
Well, I think that's actually an interesting question. I mean, picking up on Jim's point, the inflationary picture is obviously a big one to sort of think about, but I think the related point is really how the Federal Reserve responds, whether there might be a policy mistake, for example, of overcooking and over-tightening monetary policy. The issue which I think economists are grappling at the moment is that there's lots of things which we thought are fundamentally true about how the economy works that are just not working out that way. I mean, for example, in the context of both the UK and the US, how low can unemployment go before we do see this inflation and wage sort of pickup? You know, we're sort of at 4.2% in the UK, not seeing a great deal of wage inflation. Is that a reflection of the Nehru being rather lower? Is it a question that there's something else obscuring it, or is it perhaps a responsiveness to wages to unemployment is changed? There's lots of sort of fundamental things that are very difficult to unpick, and it's unsurprising, I think, that sort of policymakers and forecasters are really grappling their way through sort of by data point by data point almost.
Yes. But obviously we want to try and cut through the noise for the audience here. And just going back to that wage inflation, in a way that's helped the US economy, hasn't it, with wage growth being so low, which has meant that you've had a relatively stable economy. I mean, in a way, I think that is it the second longest US expansion in history?
Yeah, I mean, I've got this kind of big picture theory that, this is now the second longest US expansion in 170 years. We've had 4 very long expansions since the early 80s. And I actually think wage inflation is probably one of the key reasons why we've had these long expansions, because well, the reason we've had, I think, low wages is because of demographics and because of China. Since about 1980, we've gone through, the baby boomers have gone through the working age population, and everywhere around the world has seen a massive explosion in the size of the working age population. And China, at the same time, randomly decided to integrate itself into the global economy, dumped 1 billion of cheap labour onto the global economy. So everything that could have pushed down the price of labour over the last 35 years has done so at a global level. And for me, that's meant that at every stage of the economic cycle where you would normally get inflation, you've had that extra pressure down, which has allowed central banks to keep interest rates lower, allowed us all to accumulate debt, and cycles have just gone on longer and longer over the last 35 years. Now, I think this is probably coming to the end of this super cycle because if you look at the working age population now, including China, we are plateauing. So over the next few years, the working age population will stagnate or even decline. And if you believe in any kind of economic growth, workers should get a higher share of the pie going forward. And therefore, you'll probably end up having wage pressures at an earlier point in future cycles.
So not sustainable?
Not very long term, no. So I think one of the biggest trap people make at the moment is to extrapolate the last 35 years and say this is going to be the next 10 years. Whereas I think we're could be at an inflection point where from here, inflation in the last couple of years has been at the low it will be for our lifetimes, really.
And Marilyn, it seems, it's nearly 10 years since the last recession. People still talk about it, but 10 years is quite a long time. Are we due another downturn?
Well, obviously, eventually we are.
Yeah,
that's the way
it happens.
But I mean, I certainly think the Fed, particularly under Chair Yellen, was running a policy of really running the economy hot, and we think that under Chair Powell, also we're going to continue to see them running the economy relatively hot. So they've really been focusing on growth, the labour market, which is very, very tight. I do think it's very, very unusual to see an increase in fiscal stimulus at this point in the cycle. At a time when the Fed is tightening, you're seeing more fiscal stimulus, I think is unusual, and I think it could potentially bring forward potentially the downturn in this cycle. So I definitely think that's something that we're to be relatively concerned about. I also think that technology has played a huge factor. So I agree with everything that Jim said, but I also think that technology has led to lower inflation than in previous cycles. It's kept costs down. We're continuing to see M&A mergers. We're continuing to see disruption from technology. But I also think that perhaps potentially that is also drawing to the end of the huge amount of stimulus that's provided to the economy as well.
And with Powell in charge of the Fed Reserve, do you think he'll carry on in the same vein as Yellen? I mean, his first day at work wasn't great. There was a massive drop on Wall Street. Was that a coincidence, unlucky, or is he just inherited now a world economy which is starting to decline?
Well, I mean, the US economy continues to grow incredibly well. I mean, it's still really, firing all cylinders. It's doing very, very well. We think that it would take a lot, really, to disrupt the cycle and the pace of tightening that we see. So our core scenario is that we have in total this year 4 hikes. We've had one in March. We think it's going to, he's going to continue to raise rates at a fairly steady pace. So I think in terms of the US economy, he's inherited a very nice, well-performing economy. In terms of the global economy, I do think we are now seeing a lot more risks out there, which could potentially maybe next year have more of an impact. But I think this year, things look to be continuing.
So how many more rate rises are you expecting? 2 or 3 from the Fed Reserve?
So the rest of this year, we probably about 3. Next year, potentially another 3, being data dependent.
Yeah. Yep. And that's again to keep that inflation lid on.
Yeah, so I mean, inflation we think is going to be around or just above, the sort of the 2% target. But also, I think, yeah, that's right. And as you do approach the downturn of this cycle, then the Fed does need to have some sort of, dry powder with which to tackle the next recession as well.
Michael, any differing thoughts to that?
I mean, I suppose the first rule for central bankers ought to be do no harm, but a bit like medics, really. So I suppose the worry at the back of my mind is that there's a lot of, obviously, focus on how quickly the Fed will be tightening. And as long as these sort of fundamental things in the economy, how low can employment go, are sort of slightly unknowable, it is quite easy to make a sort of accidental policy mistake. I think when you add into the picture, for example, what Trump is perhaps thinking around a trade war, picture and how that might potentially engulf, not just China, but perhaps the EU. There are sort of risks out there which may, I think, sort of muddy the picture a little bit. So I guess I wouldn't be quite so convinced that the sort of steady progression of hikes is never going to really have an impact on the economy in any sort of adverse way. I think already we are seeing in the world, if you look at Argentina, for example, that relatively modest changes, for example, in the dollar exchange rate or the level of interest rates are creating sort of pockets of stress in fairly unexpected places. So it may well be that 2 or 3 hikes down the line this year, perhaps, we will see other sort of pockets emerging, which might cause sort of broader reassessment of how quickly they need to be tightening the policy.
And do you think, Trump will get the credit for this?
Just for following up from that, it's a good point, because when you've got such a mountain of debt, sometimes you don't know where the skeletons are going to actually be. So raising rates is always that's the uncertainty of forecasting at the moment. You can have the forecast of rates raising, which looks good for the economy, but if a particular area of the global economy is more exposed than you're aware of, that's where it becomes much more troublesome. So that's probably the thing we need to look at.
So at the moment, is Trump going to get the credit for what's going on? And do you think his policy of tax cuts was a stimulus too far? Did they need to do it at that time?
I'm a bit conflicted, because I think the world has been too biased towards monetary policy since the financial crisis. So governments have been standing back, and in Europe they tightened government, did austerity extreme, which caused the European crisis. So it would be churlish of me to say that the US policy was completely wrong. I suspect the US got to a point where it had enough self-fulfilling growth that it probably didn't need that. But to be honest, I think monetary policy has gone too far in trying to solve the world's problems. So I think you do need a better balance between monetary and fiscal policy going forward. So it's not all bad it's not. I wouldn't criticise it massively, what Trump has done, but I think it's probably a bit late in the cycle.
Yeah, and the role of central bankers, I mean, who are they answerable to, Marilyn? I mean, they play a very important and powerful role in society, but who are they answerable to? When are they going to stop? Because the ECB have done a huge amount of quantitative easing in terms of size in comparison to America, a lot more in comparison.
Right. I mean, essentially the role of the central bankers are to maintain a very stable environment with which financial institutions and the economy can work, which is why they target, usually inflation rate, which is why sometimes they target the unemployment rate. And their role is really to ensure that there is a very stable environment, in which business can flourish. So I think, the ECB, I would say, has a particularly difficult job. I mean, we discussed obviously the Bank of England has a very difficult job because of the uncertainties around Brexit, and the Fed have a difficult job, weighing all the different things. But I think the ECB has potentially, I hate to say it, the hardest job. It's trying to maintain an interest rate and support an economy that is comprised of so many different countries, so many completely different countries with different fundamentals, different governments. So it has a very, very difficult job. And so Ivan talked about, Germany and potentially, would we have a German, president of the ECB next, which would be very, very different, obviously, to one of the southern countries. And so I think, the ECB, I think, have done actually an incredibly good job of supporting the Eurozone economy, of actually keeping spreads down, of keeping, improving investor sentiment. When you think only back to sort of 2, 3, 4 years ago, we had, the Greek crisis, concerns around, Spain, Italy falling out of the Eurozone. Everything has improved. Investor sentiment has improved. The economy is still doing incredibly well. The Eurozone is growing very, very nicely, even if, at slightly lower levels than before. So I think that, the ECB is doing its job in supporting as much as it can all of the different economies within the Eurozone.
So let's go closer to home now, Michael, the Bank of England and Carney as a governor. How many more mixed signals can he send out about a rate rise or not?
Oh, he doesn't have that long left, I suppose, to keep confusing people, if I'm supposed to put it politely. But I suppose the interesting question is whether the sort of recent change in rhetoric has been sort of justified. And I think, if you look at the high-frequency data, certainly in the UK, there are clear signs of a sort of soft patch. The question really is a soft patch sort of durable, or is it not? I think for the time being, the Bank of England has plenty of space to basically sit back and wait and to see what the data say. And as long as these sort of fundamental quantities about how high does the neutral interest rate need to go and how low can the unemployment rate go are sort of a little bit hard to pin down. They are, I think, well in their sort of remit, I guess, to reflect on the data as it comes in. So there's sort of confusion and I guess the mixed signals that the market is interpreting. I think they are doing the best job they can, but it's essentially the economy that isn't playing ball. It's clearly the case that there have been lots of sort of ebbs and flows in the data, and really for the BE to continue tightening, they do need to have a very specific alignment of planets, if you like, to sort of have everything in a row to actually be able in a position where both the domestic economy and the international economy makes it conducive to continue tightening policy.
So how does the audience here, Jim, navigate through that noise of the Bank of England? What should they take from the current round?
This purely on the Bank of England
Yeah.
side? Well, I think the mistake the Bank of England have made is try to communicate too much in recent quarters, and there is an uncertainty about the global economy, and there's even more uncertainty with the UK with Brexit. So I think they've trapped themselves into too much of a corner. So I don't think you can listen to anything the Bank of England says at the moment and be confident of it. So I think you have to look at the global picture and realise that probably the UK is going to be a function of the global picture more than it is the domestic events, really.
And when it comes to Brexit, again, we could see from the audience that we had a mixed response when the audience were asked as to where they are in their stages of planning. Some have got their plan already in place, some are sort of hovering over the button. So those that are hovering over what to do when it comes to Brexit, what should they do now, knowing that June just might be about theatrics and noise and uncertainty will still reign? Because there's one thing that businesses don't like is uncertainty, do we? Marilyn?
So, I mean, I think there is so much uncertainty, obviously, still at the moment. I think, and when it is uncertain, all you can do is have many plans in place and be prepared for all eventualities. I mean, certainly we have at BlackRock been, planning a lot in terms of what we think might happen, different scenarios. But ultimately, we do think that a relatively benign agreement will be reached. But I think it also stretches, obviously, beyond just your business and how it runs, but also everything from if you invest abroad, if you have foreign currency. I think also hedging the currency impact, I think, will be very, very important. We've seen a huge amount, or most of the outcome of the referendum has really been impacting the pound. We saw that they feed through into inflation, and we've seen a lot of volatility in the pound. And I think now the risks are really pretty symmetrical around sort of a 135 rate versus the dollar. And so I think also just putting plans in place in terms of hedging the currency and ensuring that you're as confident as you can be in everything that you set up.
Okay, well, let's go to the audience now to see if we've got any live questions, and just to check everybody is still with us. We've got 4 microphones here, so you just need to put up your hand. Now, my eyesight is not great, so I'm going to need all of my panellists, and I think you've got John and the rest of the events team. Now, which brave soul is going to be the first person to ask a question? Remember, there are no silly questions. There's one over there. Jim's glass is obviously working well. Can you wave at us? And I can't see what microphone you've got there. Jim, I might need to borrow your glasses. I'm looking forward to this question. So if you'd like to introduce yourself as well. I didn't say that, did I, to begin with, but that'd be great as well. So thank you very much and good morning to you.
Hi, good morning. Keith Strachan. My question is about the productivity and the wage inflation and inflation generally being brought down by the point about Chinese labour. Is the next phase going to be about bots as opposed to robots? We're not getting richer because there's no productivity. Bots making finance, insurance, etc. Redundant. Is the next question the wage inflation and inflation kept down because we'll become much, much more productive, but then a social issue because where does that benefit go to and to whom?
Yeah, the productivity puzzle and bots.
So I didn't catch all of the question, but I wanted to pick up on robots. I suppose the biggest criticism I get on my view that the global labour force has now reached a peak and is now declining and wage pressures will start to move up is people think that robotics is now just about to take away all our jobs, etc. And I think it's a very valid argument. I suppose the only thing I would say is that if you go back to the Industrial Revolution start in 1760, we've been worrying about technology replacing humans for 250 years. And if you look at the unemployment rate through that, it's cyclical, but there's no structural difference. And my kind of glib view is that humans always find a way of finding new employment. We're all greedy, basically. We want to earn money, so we don't have leisure time. People that say robotics will make more leisure time, nonsense. We all want the best car, the best house, so we will all offer our services to work. And in doing so, I think there'll be other industries, etc., that come through to give us employment. So I'm not particularly worried about robots replacing.
Is that true of the low-skilled workforce, though?
I think that there's other areas that they could work. Healthcare, but it's just one off the top of my mind. But I think this will be true across the board. Yeah.
Marilyn?
I think we've already seen, as you mentioned, I think wages have been kept down by technology, improvements in technology, taking a lot of costs out of the system. I think if you look at the announcements for CapEx for this year, a lot of the biggest spenders this year are going to be tech companies. So if you look at Facebook, Google, etc., they've all announced huge CapEx expenditures this year. So it's not going to stop anytime soon. But I think, as Jim said, I think you need humans to interpret the data. You still need humans, to actually use them. And so I don't think they're going to really replace jobs, but the nature of work is definitely changing. But we are seeing it. I mean, we're seeing an increase in the use of AI in everything from the legal industry through to financial industry. And you find constantly new ways of using technology, but likewise, then humans find different ways to use that and interpret it.
Yeah, and I think artificial intelligence is the one that is rising to the top out of all the latest technology as well that seems to be enhancing the game.
I guess there's a couple of things to add to that, because I think already we are seeing quite a lot of increase in contestability of the labour market from technology. If you think about everything like Uber or Deliveroo or anything like that, that's basically creating the possibility of pulling more people into the labour market. And that goes back to this question I was making earlier really about whether the unemployment rate perhaps can go rather lower than it is already if we can basically sort of pull into the labour market people that might have been marginally attached before. So all these things, I think, potentially are creating sort of environment, even if the jobs are not replaced in a sort of a wholesale way, that wages could stay relatively depressed. But and I think that's one of these things where the policymakers will need to sort of to basically see how the data pan out. If you're cognizant of this possibility that there might be a very big shift in the way the labour market works coming just down the line in a few years' time, you are going to be relatively cautious about basically slamming on the brakes for the economy and possibly causing a spike in unemployment, which might be very hard to unwind later on. So I think my view on that would be it is another reason for them to be thinking about whether there is a structural shift taking place, which makes them a little bit more cautious about how well they understand what's really going on right now.
Great question, thank you very much. There's that balance to strike as well. And there's some countries that are not only having sort of the traditional ambassadors, but having technology ambassadors as now. I know the Nordic countries, in particular Sweden, now have ambassadors of technology, which may be the way we go into the future as well. Just very quickly before we wrap up, we haven't talked much about those frosty sort of US-Chinese relations and the impact of protectionism and what impact that may have on the audience in particular. So, Jim, any thoughts on that?
I think Trump, I know that we've got to be scored by the audience on this, so therefore I'm a bit nervous about talking about Trump positively in case I get scored down.
Go for it.
So please don't hold this against me. I actually think Trump is getting a couple of things right here, in the sense that China has been, and again I've been nervous, has been abusing the kind of international trade laws for a long time, stealing intellectual property, and previous administrations have chosen to be very touchy-feely about it. Trump has gone in with big two-foot tackle. It's high risk because if it sparks a trade war, it's not good for anyone. But you're already seeing Chinese concessions, etc. And he could end up this year making a much better trade environment for the globe and US, and he could solve the North Korean situation. So he could be man of the year.
Yep.
Please don't vote me down.
Okay, and then finally, just for all of you, just a quick comment. The audience, when they go back to their places of work, how do they navigate this noise? How do they make the most of the global trends, the positive ones, and how do they make sure they're on top of those risks and those potential black swans coming their way? So, Michael, some final thoughts for the audience. Give us some good news as well.
I think for me, it is about basically sort of increasing resilience, I suppose. And I think for me, that means looking at the variety of outcomes. My sort of focus really is on stress testing in a bank, but I imagine looking at a range of scenarios, given these uncertain times, is sort of a way to think about these sort of uncertain ebbs and flows of the economy, which are really quite hard to pin down as sort of base case view. I say that as an economist, with sort of, which might be slightly doing down my profession, but certainly crystal ball gazing is not easy. So having a range of views which covers this sort of span of outcomes is, I think, one way to sort of help mitigate that uncertainty.
Marilyn, same to you.
I mean, I would say certainly in terms of risk management, if you analyse all of the allocations that you have and you look at the changes we've seen in the correlations between the equity market, the bond market, other assets that have changed very considerably, taking a good look at them, running stress tests and seeing whether your hedge part of the portfolio is really still working as a hedge.
Yep, particularly as we saw in the survey that Treasury are having an impact on board decision making when it comes to liquidity, when it comes to asset management and that like as well.
Yes.
So wise words. Jim, try and get your voting up now.
I would say the final thing I would say is that as treasurers, when you look at yields, they're at multi-century lows, close to in many countries around the world, especially in Europe. Do you really think that's where we'll be in 5-10 years' time? Are you planned enough for a world where yields are notably higher than where they are today? I think they will be. There's a lot of uncertainty, but I suppose that's the key thing I would say.
Well, thank you very much. You've just heard Jim from Deutsche Bank, Marilyn from BlackRock, and Michael down at the end from the Lloyds Banking Group. Thank you very much for your question as well, and may you have a fantastic conference going forward. We're going to hand back to Peter now. Thank you.
Please show your appreciation to the panel. OK, we're going to take our first break of the morning now. Just to remind you that Sir Ivan will be downstairs in the ACT Thought Centre if you have any questions or comments you'd like to put to him. Form an orderly queue, as they say. And the next sessions will start at 11:45. Please refer to your app for the conference agenda to decide which of the track sessions you'd like to go to. Thank you very much. Thank you all.